As mortgage rates remain the highest they have been in 12 years, here's some practical tips if you're coming up to remortgage within the next 6 months. If you've got longer than 6 months left, I'd highly recommend you check this video out. Quick disclaimer, although I am an independent financial advisor, none of the content in this video should be deemed as advice. This is information only. Any specific advice should always be based on your specific circumstances, and I strongly recommend you speak to a financial advisor before making any decisions or actions. Now, the first thing to mention is there are 2 options you have when it comes to refinancing. The first one is called a product switch. Now, this means borrowing the same amount of money over the same term. The advantages of this is it's a much smoother process. There's generally no affordability questions, and there's also no legal works involved, so therefore that saves on the cost. The disadvantage of this is you're restricted to the products that they have available, so you can only pick from one of a few options. The second option you want to consider is a full remortgage. Now, that means that you're applying to a new lender, which means a full application. Now, one of the advantages of this is that the rate may be lower. So if you were with a lender initially, perhaps a specialist lender that charged a higher rate, the advantage is you can switch to a lender that will charge you a lower rate, which will save you money over the long term. You may also be able to change the term. So for example, if you want to extend your mortgage, as long as that meets the lender's criteria, then that will be possible. The disadvantages of this would be, first of all, it takes a little bit more time to process. Things aren't guaranteed. And also you have additional costs involved, for example, legal works. If by looking at both of the options, all the monthly payments seem very, very high and unaffordable, there's still some things you can do. The first thing I would consider is speaking to your lender. Now, there are certain things that your lender may be able to offer you. For example, mortgage payment holidays, interest-only payments for a certain amount of time, things that can help you reduce your outgoings in the short term. However, I would carefully consider all of these options because it could end up that you're paying more interest over time. Now, interest-only mortgages aren't very common. However, there are certain circumstances where you can obtain them. There's also a part repayment option available with some lenders, which means you can repay some of the capital and some of the mortgages on interest only. Now, this might sound obvious, but any part of your mortgage that is interest only will still have a balance at the end of the mortgage. So important to consider this maybe as a shorter term fix and ensure you have another plan in place for repaying the capital. Now, if you have a spare room, you might want to consider the government's rent-a-room scheme. Now, as the name suggests, this government scheme allows you to rent a room out within your property whilst you're still living there, and you can take up to £7,500 a year. That's £625 a month, and that's completely tax-free. Now, if you have the option to move out of your property, there are a couple of things you could consider. The first thing is called consent to let. So that allows you to rent out your property using the existing mortgage that you have. Now, lenders need to be aware of this and you need to apply for consent to let. Sometimes there's a nominal fee for doing this, but most lenders allow this to happen. So perhaps if you have a high rental capacity for your property and you can't afford to live there, you could maybe rent out the property on this basis. Now, this usually involves exactly the same terms as your current mortgage, so it's likely to be on a repayment basis, and you need to account for things like tax and maintenance. So this may not be a viable option, depending on how much your monthly payments are going to be versus the amount of rent you can achieve. The second option there is to look at a remortgage to a buy-to-let. A buy-to-let is interest only. The monthly payments are going to be lower. However, if you do remortgage to a buy-to-let, do consider that most lenders need you to have a residential property in the first place to have a buy-to-let, so this may not be possible. Also, there's other things to consider, not only income tax, but also capital gains tax when you come to sell the property. The final thing I would consider is selling the property, and you may wish to downsize, whether that's in terms of size or area, maybe move to a cheaper area. Now, there's many costs involved with this in terms of downsizing, legal costs, etc. So it's not something to be considered lightly. But if you can downsize and take into consideration all of the costs and it's still worth it, then that's something to consider. Now, the final thing to mention, if you're truly overwhelmed with all of this, then there are some places you can go to for help. Not only if you're struggling with your mortgage payments, but also if you're struggling in general with debt, things like credit cards, loans, things like that. And if you feel completely overwhelmed, perhaps you've got lots of debts in the background that you're unsure of how to pay, how to prioritise, please do reach out. There's some links below that may be helpful, but whether it's an advisor, a lender, or a friend, it's really important that you reach out and start the conversation, start thinking about things, start planning, and you will feel better once there's a plan in place. As mentioned before, there's a part 1 to this video that you may want to check out. I hope this video was useful, and until the next time, stay mindful.